It's time now for today's strategy session. For investors expecting rate cuts this year, you may have to wait longer than expected. Goldman Sachs expecting little moves on the rate front in 2025, with easing coming next year as the president's trade policies muddy the Fed's outlook. Traders are ramping up hedges against big shifts in the Fed's interest rate path, indicating they expect higher for longer rates. The chart here showing a contrarian wager that the Fed won't cut interest rates this year. Looking at futures contracts for the secured overnight financing rate, which closely tracks the rate that is set by the Fed. Joining us now on this, we've got George Bory. He is Allspring Global Investments Chief Investment Strategist for Fixed Income. It's great to have you here this morning, especially in the context of some of the labor market data that we have been getting in here. What does any signal of softening in the labor market mean for the Federal Reserve? It is bad news in the labor market, good news for folks who want to see rate cuts this year.
Yeah, hi, good morning, and thanks for having me on the show. But Madison, as you mentioned, we had some weaker than expected job data today out of ADP, showing kind of a deceleration in job growth, and that has been a consistent theme that we've been seeing kind of unfold over the course of this year. Jobs are important. They're important for the Fed. The Fed has really kind of coalesced around around expectations for the labor market. And if job growth is slowing or shows ongoing signs of slowdown, that provides sort of the opportunity, if you will, for the Fed to start cutting rates. As you point out, the market's not expecting much. Right now, the market's expecting 2 rate cuts between now and the end of the year. But we might see that start to change, particularly if the job market does slow. And on Friday, we have the payroll report. We'll see the market is still expecting payrolls to be up 130,000 last month. But we'll see what kind of numbers ultimately come out, as we know that can be a very volatile data series. So, we're kind of in wait and see mode, similar to the Fed. But the most recent data would suggest that the labor market is softening, at least on the margin.
George, what is the likelihood that, especially as companies are increasingly citing uncertainty because they don't know how some of the trade deals are going to net out, at what point do companies not only adjust how much they're looking to hire, but also say, okay, if we're not anticipating a deal, perhaps that becomes the new baseline, is that we don't anticipate a deal and that we actually do have some certain, like that, the uncertainty almost becomes the uncertainty in that frame of mind there.
No, you make a great point. Tariffs have been difficult to calibrate. Number one, it was a big surprise back in early April. We then had the tariff announcement extended. We're in the negotiation period, and now we're seeing sort of pushback from the judiciary side of government. So tariffs remain a meaningful question mark kind of hanging over the market while we're in, again, kind of this wait and negotiate phase from the government's perspective. You're starting to see revenues flow into the government. That's a positive from the government's perspective of having more cash. But as you point out, for companies, it's difficult. It's difficult to determine how we're going to hire, how they're going to spend money and invest in capital, and how to make strategic decisions as it relates to acquisitions and mergers and sort of the build out of certain industries. So there's been a notable slowdown in some of that activity. What we are seeing, at least in the bond market, is that we're seeing an ongoing and a meaningful wave of refinancings as companies take advantage of what's a more calm environment right now in the bond market. Bond yields have come down a bit, and as I mentioned, that data is kind of putting some downward pressure on yields, upward pressure on price. That creates a window here for companies to shore up their balance sheets. We think that will continue to the extent volatility remains low, and companies want to get ahead of the unexpected, the known unexpected sort of scenario as it relates to tariffs, and we're going to have to wait and see.
How does the tax bill play into that dynamic you laid out so well in terms of company uncertainty? Does that provide any sort of Band-Aid to that wound?
I think it potentially it does, but we have uncertainty there as well. I think on balance, the tax bill, at least as it was presented from the House, would on balance be pretty favorable to the corporate sector, we think, and we'll see what the Senate is likely to produce. But But we see some really good things coming through as it relates to the expensing of capital spending and initiatives to encourage companies to invest in certain industries, certain places like energy. Those types of incentives should help corporations and could help them quite a bit. But similar to tariffs, we're still in wait and see. So we think we're in this environment where over the summer we're going to have to kind of wait for a little while. Like, again, thinking about what's happening here in the bond market, it's kind of steady as she goes as we wait for these outcomes. To the extent we get some of the things that are proposed, that should help corporations. It should help both the stock side and the bond side. But we have to wait to see what Congress ultimately delivers.
I want to switch gears ever so slightly and talk to you about foreign demand in the bond market. We've been talking about the risks of the deficit to the bond market so much, but I wonder too how you're thinking about risks of de-dollarization, of declines in the dollar that make it just too risky to own too much stock in terms of U.S. equities or too much of U.S. Treasuries.
That's a great point. And as a bond investor, we are global bond investors. We invest all around the world. We also have clients from all around the world. So we watch this very, very closely. And to date, we have not seen a meaningful shift away from the U.S. We watch the bond auctions on the Treasury side. We also look at the demand data that comes through on the corporate bond issuance side. And it would suggest that there's ongoing demand from non-U.S. investors for U.S. debt. And that gives us some confidence that should persist. There's still a lot of excess savings around the world. Much of that money has to be recycled, and much of that money ultimately goes into U.S. dollar debt securities. There is obviously a longer-term question mark on how long that will last. Are we reaching some sort of tipping point? Is there going to be a buyer strike from international investors buying U.S. dollar-denominated debt? We have not seen that yet, and we look at all sorts of different data that could suggest that. But so far, the demand has been fairly robust. Different points along the curve have different levels of interest, and we've seen the long end kind of show some weakness from a demand perspective. But as we move further down the curve, there's still very strong demand for both for U.S. government debt, for corporate debt, for mortgage-backed securities, and even for municipal debt, which is always, I find, kind of interesting. Non-U.S. buyers buying municipal debt, again, kind of ticked up. And I think it really goes to the heart of just a good, attractive yield, good, attractive nominal and real yields, and then, very importantly, great diversification across the U.S. It's the deepest, broadest bond market in the world, and investors from all around the world still want to access that.
We got a Muni Mentions 10 minutes after the open here. George, thanks so much. We appreciate it.
Thank you. Have a great day.